Well, good afternoon or good morning to you. For those of you on the West Coast, my name is Tony Whitbeck. I'm the CEO of Key Management Group. And with me today is Todd Doherty. And Todd is our Director of Acquisition and Legacy Planning. And he's going to be taking us through the majority of the content since he is the expert on practice valuations. So as you can see, you are attending a webinar on practice valuations, but before we jump into the content, I want to take just a minute to share with you the services that we offer at Key Management Group in addition to business valuations. So as you can see on your screen, we offer executive coaching, which is really designed for the owner of the business. And we're going to work on things like vision, foundation, your personal and professional goals, growth strategies, building your team, managing your employees, and your practice value proposition, your value proposition. Secondly, we offer a practice management program, and this is really designed for the entire team. And it's going to focus on roles and responsibilities, service schedules, systematizing the client experience, tracking tasks, accountability. And then we also offer our Connect practice management platform, which is a proprietary software program that we put together. So this is really focused around the operational side of the business. Then we offer two outsourcing services. We do client meeting preparation, so we prepare you for your client meetings, and then we do financial plan production as well. And then finally, our fourth category is acquisition and legacy planning, and we have a number of services here. We have our advisor legacy platform where we help people buy and sell practices. We do business valuations. We do hundreds of valuations a year, not only for advisors, but for financial institutions that lend to the financial advisory industry. And we have some profit and efficiency analyses, and then we also have some turnkey continuity plans to protect your practice in the event of death and disability. So those are the services that we offer, and so at this time, we're going to get into the content of today's webinar, and so I'd like to introduce Todd. Todd?
Thank you, Tony, and thanks everyone for taking time out of your schedule to join us today. What we're going to do today is talk a little bit about our valuation service specifically, but really spend most of the time talking about financial advisory practice valuations in general, and what drives value in a practice. We'll also talk about towards the end of the presentation what are some of the external factors like the Department of Labor proposal and so forth that can influence the practice from an external standpoint. You might have heard valuations or the valuation industry described as part art and part science. It seems like a strange description to me, and people in the valuation business refer to it that way as well. And I think really what that means is that there's two different types of measurements that take place when a valuation is done properly. One of them is a quantitative measurement using metrics and analysis and formulas and so forth. The other one, which I think is equally important, is a qualitative measurement, and you really need an analyst who understands the business in a very deep manner in order to make a good qualitative measurement about the practice. I think a good analogy regarding that is, if you had a bottle of wine, you could measure the volume of it, you could measure the alcohol content, but what you can't measure is the flavor, and really that's that's kind of the qualitative measurement, if you will, in a financial advisory practice valuation. Really quickly, just to kind of expand on what Tony introduced in terms of our services, specifically around practice valuations, we're a preferred vendor for several broker-dealers, including Ameriprise, Cetera Advisors, and Northwestern Mutual. And then we also provide valuations for several of the banks that do the majority of the lending for acquisitions in our industry. So that type of exposure for us gives us a lot of validation around the results of the valuation, because we see deals on almost a daily basis. The other area where we get a lot of validation as well is we have another service that Tony mentioned called Advisor Legacy, where we sell financial advisory practices, and we really see in that process, what is the current market value. We allow people to make bids in that process, and so, we see what people are willing to bid when, the buyer makes the choice on the price that makes sense for them. So let's launch into the content for today. As you'll see on this slide, this is a research done on what prevents business owners, small business owners, from planning. And the first item, which is probably the number one item on almost any list like this, is procrastination or finding the time. And I think most people probably could find the time. It's just, sometimes it's easy to put things off. Number two, and this is the key one for our discussion today, is failure to obtain a proper valuation of the business. Number three is failure to identify the succession team. Number four, failure to integrate the business or succession plan into the estate plan. And then lastly, failure to plan for the 4 Ds, which is death, disability, divorce, or departure. So let's talk about the failure to obtain a proper valuation on the business. If you think about your ability to make an informed decision, and really this applies to anything succession related, but also to growth related items. If you think about managing your asset, which is the value of your practice, and it's for most financial advisors, it's their largest personal asset, or certainly one of their largest personal assets. Making informed decisions around that is extremely important, and the starting point in most of those considerations is a business valuation. So you can see why that's the hurdle for completing or even starting a process. If people don't take that step, it's hard to move forward in making good informed decisions. So a little bit about our process specifically. As you can see here, we have discounted pricing on our valuations for our partner firms that you can see listed on the right-hand side. The partner firm price is $7.95 versus the street price of $11.95. We use 2 different methodologies of value in our process. The first thing that we do is we conduct a market-based value assessment. And the way that we do that is not that different than how you would see value performed on a home or an appraisal on a home, where we're comparing the practice, the size, the metrics of the practice to similar practices that have sold in the last 12 months or so, and arriving at what we feel would be the average of the fair market value for that practice. And again, we have a lot of constant feedback in that area based on our involvement in the industry and selling, buying and selling and consulting on practices being bought and sold. The second methodology that we use is a discounted cash flow or earnings-based valuation, and both of those methodologies are equally important. You want to know what the market will bear at any given time. There's a lot of external factors driving that, which we'll discuss later. But you also want to know what the cash flow will support, what price in terms the cash flow will support, and also what is the proper return on investment for the buyer, because we have a firm belief that any deal or any sale really has to work well for both parties. It's not a successful deal if it's very one-sided, and so looking at both of those methodologies gives more balance and evaluation that it is the right deal for both parties. One of the things that we recognized early on in getting into the valuation business is what we were seeing at the time was people would buy a valuation, they'd get this substantial deliverable of 60-some-odd pages, and then they would flip to the page that has the price on it, And it really didn't go much further than that. And our feeling at the time was, you're really not getting the value that you paid for if that's the extent of your experience with evaluation. And so what we've done since the very start of performing valuations on advisory practices many years ago is we always have a 1-hour consultation going along with the deliverable where we're going to review the results of the valuation, and probably just as or more important is we're also going to talk about how do you use those results to achieve the goal. And, that could be various different goals. You might be looking to increase the value of your practice over time. You could be looking to increase profitability in the business, which our valuation goes pretty deep into. You could be looking to sell the practice, and that's going to give us a lot of great information about, the potential sale of the business, the timing of the sale, and so forth. So we've always felt like that was a key component in our delivering evaluation. I think that's where a lot of our clients get the most value. The illustration that you see on the screen right now is a very interesting analysis that we conducted in early 2015. One of the things that we recognized is, and this is probably not exclusive to financial advisors, but certainly very common in our industry, and that is, advisors are always asking, well, what's the average? What's the average valuation? Or I think someone asked me this just yesterday. What are the multiples of revenue that people are seeing today? And I've even seen circumstances, several times at least, where practices were bought and sold based on rule of thumb measurements or using, average multiples of revenue. And so I want to show you in this illustration why that is certainly not a good idea. So the analysis that we performed was based on all of the valuations that we had completed in 2014, and we looked first at what was the average size practice that we valued. And the average size was $81 million in AUM and $672,000 in GDC before payout. So the different ways to express that result of the valuation, which is average valuation was $1,258,000 for that size of practice, was 1.86 times gross GDC or 1.55% of AUM, just as a different way to look at the result. The really important thing with this analysis, though, is that we also looked at what were the top and bottom 20% of valuations and relative value, and that's the result of the valuation compared to the sale price. And so what we found is a range of 80% between the top and the bottom 20% of relative value, and the range represents $767,000 for this average size practice. So the bottom 20% valuation for that same size practice would be $960,000, and the top 20% would be $1,727,000. So hopefully what you would take away from this is, first of all, that there's quite a range. The quality and other factors in the practice can really have a big influence on the valuation. And probably just as important is, if you were to use a rule of thumb type of measurement, you're going to be wrong most of the time. But, the thing is, you might be lucky and you're only off by a few $1,000s, but you can see here where you could be off by a few $100,000 in doing that. And it's certainly not a good way to, to make an informed decision about such a significant transaction and such a significant part of your own personal portfolio. So let's take a look at, relative to that analysis, this is a part of the deliverable of our valuation where we express the result. Above this, you would see the dollar figure that was assigned to the practice. But we express the result in multiples of gross GDC and compare it to those averages so you can see how your practice compares to the average or the bottom and top 20%. And what this also shows you is that, let's just say you're at the average, what difference it would make in the value of the business if you were in the top 20 percentile, and what that dollar figure is. So this is the output of an actual valuation, and you can see here that the advisor had, a strong value. It's above average, 1.99 times gross GDC. But what you can see below there is that if they were to improve the metrics of that practice to the point where they were at the top 20% of value, the difference in dollars would be $800,000. So again, going back to the idea of the value of your practice, the equity in your practice being one of your largest personal assets, wouldn't it be worth managing that asset to gain another $800,000 in this case in value, or somewhere in between where they're at now and $800,000 in value? I think most people would say it certainly would be. If this was an asset in your client's portfolio and you knew that you could drive that kind of improvement, I'm sure you would put the time into doing so. What we've seen in practice of people that we help manage the equity in their practice through regular evaluations is you can really drive improvements, in less than 2 years' time in most cases. I've seen people make significant improvements in as little as a year, but generally speaking, within a 2-year time frame, you can certainly make a lot of improvement unless you're already in the very top range, which it becomes more of a challenge. That would apply to anybody except for someone who's looking to sell in the very near future. In that case, you can't really drive a lot of short-term improvement, but you can certainly drive it in the longer term. So let's take a look now at what drives value in a financial advisory practice. I like to think of things in more simple terms, and so I've kind of separated out 2 different buckets that you can look at different areas that drive value in a practice. The first of those is what we would refer to as book of business value, and that type of value is really more focused on the client group. So what is the quality of revenue from the client group in respect to recurring versus transactional revenue, those sort of things which are highly focused on by buyers? What is the client age? Average age of clients is certainly a big driver of value in a practice. As our clients are getting older and older, getting past the stage where they're accumulating assets and starting to get into the withdrawal phase, that certainly has a significant impact on the value of the business. We look at other things like asset velocity. What is the revenue as a ratio to the assets under management? And there's kind of a sweet spot there around a velocity of 0.8 up to about 1. Velocity above a 1, 1.1-ish, generally starts to become a little bit of a risk to the buyer in that they might not be able to generate the same type of revenue that the seller was relative to the assets. And then lower velocity is generally looked at as an opportunity for growth, which it certainly is in most cases. So we have a number of benchmarks in our valuation process where we compare these key due diligence metrics, compare your practice to the benchmark, gives us a much better overall feeling for the practice, and also allows us to see, which things are favorable, which things are lagging, and so forth. The other type of value, and this is one that's becoming more and more significant over time, is what you would refer to as enterprise value. More simply stated, I would say that that's the value of the efficiency and profitability of the business. So the things that impact enterprise value would be the team practice, who are the team members, how efficient is the team, what skill sets do they bring to the table. Certainly the systems that are in place can impact efficiency. If you've got good systems, then you may likely have lower expenses in many cases, and you'll be more efficient and profitable. We focus a lot on the P&L of the practice, and again, we're comparing that to benchmarks for profit and loss for a practice of similar size, and so we've got some really great efficiency metrics and P&L metrics where we're looking at overhead expenses, we're looking at profitability per client, so on and so forth, and comparing that to the benchmark. One of the things about book of business value versus enterprise value is relative to the size of the practice. And I would say in our industry that the book of business value has been more heavily weighted in the past, but that we're moving towards more weighting on enterprise value, and let me explain why I think that's the case. So if you think about a smaller practice selling, you've got a solo advisor, one assistant, and you've got, a couple 100, 300 clients. Usually that sale of a practice like that would go to a much larger practice, and the average is about twice the size. The buyer is twice the size of the seller. And in a situation like that, you're really selling the client group and the revenue that goes along with the client group, but not the ongoing enterprise itself and not the expenses of the practice. It's really the expenses of the buyer that are relevant in that situation. So that's what you would think of as a book of business sale, where you're not taking over a big team, you're really just absorbing that client group into your existing infrastructure. Enterprise value is sort of the opposite, and this is where your larger practices and their profitability become a major, major factor. Because of that type of practice sales, where you've got multiple AFAs, you've got multiple staff members and so forth, you're going to likely take over the operations of that enterprise as a buyer. And when you're doing that, then it's all about the profitability and not necessarily about the book value, at least in its weighting. The other item that's really significant is, the larger practices sometimes struggle with profitability. And, I think in the future, that's going to be where, that's going to really determine which practices get a premium value, which get an average value, and which are undervalued relative to the size of the GVC. So I think what we're seeing is a shift towards enterprise value as, of course, practices are getting larger and larger due to the consolidation in our industry. What you see on the screen now is part of our benchmark analysis. And again, this is an excerpt from our valuation deliverable. What we do, as I mentioned previously, is, we track a lot of benchmarks from our valuations of a sample of approximately the last year worth of valuation, so it's updated in real time, very current information. And the goal here, again, is to look at some key metrics, see how the practice stacks up against those metrics, better or worse, and then that gives us a better overall feeling. It can also point out areas that need to be looked into deeper, and I'll use average client age as an example of that. So what you can see on the page here, the very bottom metric is the average client age, and our benchmark currently is 59 years old for all clients. This particular advisor had an average age of 58, which is quite good. But let's just say, for example, you had a higher average age client group, say it's maybe 64 or something like that. That tells you a little bit about the general risk, but not about the specific risk. And so what you would need to do in a circumstance like that, which is one of the reasons why we look at these metrics, is go a little bit deeper. And so what you might do in that circumstance is, take a look at the A clients. You'd actually need to speak with the advisor and see, are they doing generational planning? I think that's a pretty variable item for most advisors. Some do a very good job, some don't do it at all. And that's really what's going to tell you, what is the real risk involved in that. But looking at the averages gives you kind of a higher level feel for what that risk might be. Other key metrics, and this is just a few samples of the several that we look at, are recurring revenue is certainly a big focus among buyers. It represents the consistency of the revenue base, probably represents somewhat of the risk because transactional revenue, of course, has to be recreated each month. And then averages of client GDC, AUM, and so forth. And we'll go deeper into segmentation because that's a big focus of our analysis now, as we've seen through looking at hundreds of P&Ls each year that client segmentation is very closely correlated to efficiency and profitability. So speaking of efficiency and profitability, the chart that you see is based on our metrics for overhead expenses, and this is a ratio of overhead expenses to revenue, not GDC, but actually revenue, so that's GDC after payout. And overhead expenses include all of the expenses of operating the business with the exception of the owner's compensation, and this is before tax. So as you look at this and you see, per these different size ranges of practices, so from 0 to 250,000 in revenue, the expense ratio is 40%. 250 to 500, it goes up to 47. You'd have to ask yourself, what's interesting about this chart? What question would you ask about this? And I do this presentation at conferences, and somebody always is quick to point this out. And the thing that's surprising, I think, to most people about this, these results, and these are real results from real P&Ls, is that the larger the practice gets, the higher the ratio of expenses becomes. And I think the reason that that's somewhat counterintuitive to a lot of advisors is that you would think that there might be some efficiencies of scale in that the larger the practice gets, the lower the expenses would become, but that's not the case, and it hasn't been the case, actually. And, different firms have tracked these metrics, Moss Adams and so forth, and their results have been very, very similar to ours. So again, if you're thinking about, going back to that enterprise value, you can see where, just based on the results alone, where profitability becomes more challenging as a practice gets larger. Then you might ask the question, well, why is that the case? Why don't we find those efficiencies of scale? I don't know that there's one answer to that, to be honest, as many of these I've worked on. But I think a couple of things stand out to me, at least in this process. And one is, I think a lot of times there's a drive for growth for the sake of growth, but they're not managing the profitability at the same time. And certainly a lot of growth is acquisition-based, and there's nothing wrong with that. It's a great way to grow. But while you're doing those things, you do have to have a strategic plan to manage the profitability of the business at the same time. And I think that's the piece that's often neglected. The other item that stands out to me in this respect is it takes a different kind of leadership to run a larger business. And most advisors are excellent practitioners, but I think it's out of the wheelhouse of many to provide leadership to a larger team, and that can result in, in having a team that's, maybe more people than is necessary, so on and so forth, and, not as profitable as it could be. So certainly, you'd want to very much, if you're in that growth mode and you're building your empire, so to speak, you really want to keep an eye on profitability and make sure that that goes hand in hand, because you don't want to get, 10 years down the road and ready to sell your business and then, have the buyers look at your P&L and say, well, this is not worth as much as you thought, based on the net. So on the next slide, again, we're going to one of the parts of the deliverable of our valuation. Here you can see a practice size range is $1 million to $1.9 million. The revenue of the benchmark is $1.4 million. The revenue of the practice being valued is $1.2 million. And in this particular result, you can see that overhead expenses, the benchmark is 51%, and the advisor's expenses are 49%. So slightly better than the benchmark, and that's a good place to be. You can be a lot lower, but at least as long as you're not over the benchmark, there's nothing wrong with that, certainly. So the key here is, the first step is managing your P&L. And, I know that's not a lot of advisors do that, but I think maybe I'm seeing more doing that over time. But then beyond managing it, you kind of need to know where it should be. What are the benchmarks? What should your targets be? And once you can compare that to where it should be for a practice of similar size, then you can strategically manage the expenses to get to that stage. And so let's say, for example, if you were considerably above the benchmark, then you probably could make some assumptions about why that is, and generally that's either, most of it is usually labor. And so you need to think about some efficiencies that would reduce the labor costs in your business. But that's the key, really. I mean, you need to know how does it stack up against, a practice of similar size, and then start strategically managing those expenses so you can get them in line, and that will certainly impact the value of the practice. So as I mentioned before, the other key driver in the efficiency and profitability in a business, in a financial advisory practice, is client segmentation. So if you think about two different types of efficiency, again, I kind of think of things in simple terms, two different buckets. One of them would be the overhead expenses of the business. So literally, what does it cost to run the business? And, we've seen some of the things that influence that. It could be efficiencies. It could be, the location, if it's more or less expensive location, and so forth. The other type of efficiency comes very specifically from the client group or the client segmentation. And this is also one of the reasons why, the broker-dealers are highly focused on client segmentation as well these days. And this illustration that you can see on the screen right now will tell you why. So if you look at the three different segmentations of clients that we measure, one of them is 0 to 100,000 in AUM. We refer to those as basic clients. The next group is 100 to 500,000 in AUM, and we refer to those as high-value clients. And then the final group is above 500,000 in AUM, and we refer to those as affluent clients. What you can see from the benchmarks is, for the average practice, 46% of the clients are basic, 38% are high value, and 16% are affluent. You can also see the average age for each of the client groups there. The average AUM, and this is one of those 80-20 rule kind of things, where 80% of the assets in your practice come from the affluent client group, and probably close to 80% of the revenue as well come from that affluent client group in a lot of cases. So you can see, 33,000 for the average AUM for the basic client, 242 for the high value, and almost $1 million for the affluent client. And the last line is what's really important. And keep in mind when you're looking at these numbers that this is gross GDC averages, and so this is before expenses. And so again, if you thinking back to that previous slide where we showed you how much on average go into expenses, you can take that off of the top of these numbers. So for basic clients, the average GDC is 378, for high value, 2,200, and then for the affluent group, 8,000. And so if you were to reduce those by 40 or 50%, you can see why there's such a huge difference in profitability with these three different client groups, and why, your ratios of these clients can really make a big, big difference in the profitability of the practice as a whole. You'll hear a lot of people make the argument that, well, it kind of depends on how much time you spend servicing the clients. But I can tell you without a doubt that that argument doesn't make sense, because the differences in the time don't make up for the differences in the revenue. You would have to spend a ton of time with the high net worth clients and no time with the with the basic clients, and you still wouldn't make up that gap in the revenue, as you can see by the differences that are on the chart here. So client segmentation is a big part of what we analyze now in our valuation process, and this is the reason, because it's so directly correlated to profitability. So here's another example of that, where we break out these three groups and demonstrate where is your revenue coming from, where are your assets. And what you can see here for this particular practice is the affluent group is generating 70% of the revenue, the high value group 25%, and the basic client group 3%. And considering that the basic group generally represents 40 to 50% of the clients, and they're only generating a very small percentage of the revenue, that goes back to the idea or the strategy of trimming clients from the book, and not spending a lot of time on those basic client groups, and really focusing on the higher end, the high value, and the affluent groups to grow that part of the book. And that is a successful strategy. The metrics support it, the results support it. On average, the average practice spends approximately 2 months out of the year in total service time in the basic client group. So if you think about 2 months of your year spent servicing those clients that are producing a very small percentage of the revenue, certainly that time would be much better spent on the upper groups and building that part of the business. And people that cut the lower end of their book almost always increase. I think the average increase in GDC is nearly $50,000 by doing so. So I talked about some of the external trends that can influence the value of a practice, and it's really interesting because the time that we're in today is almost a perfect storm of those items that can impact value, and everything has been really positive for the last maybe 5 years or so, and we've seen a year-over-year increase in value. But we're at a turning point where most of those positive factors are going to turn around into things that are likely going to decrease value. I'm going to talk about a couple of those items. So the most important of these is simple supply and demand. I'm sure I don't need to talk too much about the retirement of the baby boomer generation. You've all heard the story. What you might not know is that the year 2020, so 4 years from now, is projected to be the #1 year in U.S. history for business transfers, and our industry is no different in that respect. And so we're going to see each year leading up to approximately the year 2020, more and more practices for sale. What we also know is we don't have that next generation of advisors who can service those clients. So we're going to have fewer and fewer buyers available to purchase those practices and clients being sold. There's a lot of other dynamics that go into that. You're getting more and more consolidation as a result, and there's some limits to people's ability to manage those very large practices. And so we're currently in a seller's market still, but I think this is a pivotal year where we're going to start shifting into a buyer's market, probably in 2017, and then it will be more and more so a buyer's market as we move closer to 2020, and then that trend ends in approximately the year 2030. The other item that impacts the value of a practice positively right now is the cost of capital. And, as we know, interest rates have been very low for some time. They're at historic lows. And so if you think about that, the likelihood is that, they're not going to probably go down much, and probably over the coming years, it's more probable that we'll see an increase in interest rates. The reason that that's so significant right now is the majority of practice sales are bank financed. And it used to be that, most sales only 3 or 4 years ago were seller financed, but now I would say close to 100% are bank financed. And of course, bank financing is very tied to interest rates being, as attractive as they are today. So that has a big impact on what a buyer can offer for a practice. And right now, they're able to offer premium prices. Client age, I guess we don't need to beat that one up. I've talked about it a little bit. And, unless you have a larger team practice where you have younger associate advisors bringing in a younger professional clientele, then it's likely that your average client age is increasing every year. And at some point, it would really impact the value of the practice, if the buyer can't see, a future in that client group, if they perceive that client group as diminishing revenue and assets over time, it becomes a lot less attractive. The stock market, we've already seen that this year. We were talking about that the previous year, that, we've obviously seen some incredible growth. But, we started out the year with the volatility, and so we're already seeing what could be a shift there. Certainly going into a bear market is going to have some impact on the underlying value of practices by way of, the asset value and so forth. And then lastly, and this is obviously a very timely subject, the Department of Labor proposal. You can imagine that we've had a fair number of conversations around that in respect to the value of a practice and, concern among buyers of what's going to happen. We don't know the facts yet, as you can imagine. But I'll tell you a little bit about, the way that we are looking at that in respect to practice value and also, to sales. So we're not allowing the DOL, the unknown results of the DOL impact the value of a practice currently, because it's just too much of an unknown and very hard to quantify. It can be addressed, the risk of the DOL proposal can be addressed in a specific agreement for the sale of a business through adjustable terms. But it really wouldn't be fair to say, well, we see this risk, we don't know what it is, and so we're just going to discount your practice by 15%. And so the way that we look at it in respect to a practical purpose is, let's just use an example. So say, you've got $100,000 annual GDC and 12B1 fees from qualified accounts. And the work that would be involved is for the advisor to go back to those clients and, adjust the fees so they're at par with where they were, just a different, way for the fees to be paid. And so of that $100,000, let's say, for example, you get a couple of clients who aren't willing to do it and so forth. And so the real result is probably quite low. And if there is an impact because someone wasn't proactive in doing the work, then that impact is also likely temporary in most cases. So because of that and the fact that it's still an unknown factor, at the time we're currently handling it in the agreements and not necessarily in the value of the practice. And I think that's the right thing to do unless we find out it's a lot more restrictive than the proposal that people are currently thinking about right now. So I think that's it for as far as the content, and I'm going to hand it back over to Tony, and hopefully we can open it up to some of your questions.
Great, thank you, Todd. So at this point, we're going to do the Q&A portion of today's presentation. So for those of you who are on the phone and would like to ask a question on the phone, you can unmute your telephone by dialing *6 and then just go ahead and start speaking, or you can use the chat functionality. Again, there should be 4 I believe there are green circles on the top of your screen. One has a quotation bubble in it, and when you click on that, it opens up the chat function. So let's go ahead and take our first caller. The deathly silence that we normally hear. Remember, folks, there are no stupid questions. Todd covered a lot of information, and so there's got to be some questions from some of you. Well, while you're either getting the courage or you're thinking about your questions, you can go directly to our website. You'll see here it's www.keymanagementgrp.com. And you can, under the Services tab, go to Acquisition and Legacy Planning and then Business Valuations. And you order the valuations right online. Once we receive your order, then you'll receive an email from us, which will have a link. And that link, when you open up, there's some questionnaires, or a questionnaire with less than a dozen questions, and then instructions on which reports from your firm that you should attach to the questionnaire. And so for Ameriprise Advisors, as an example, there's two reports. There's the Practice Performance Statement and the GDC Trend Report. So those two, along with the questionnaire, is all we need to get started. One of the questions we just got online was, can you talk about the time frames from negotiation to full transfer of clients? So I can talk briefly just on the time frame for the valuations. We typically, once we receive the information from you, we typically can turn around our valuation within 5 to 10 business days. Regarding the time frames of selling a practice from the time negotiations begin to the time of the full transfer of the clients, Todd, would you like to address that one?
Sure. So I can speak to our process of helping sellers sell their practice. It takes us on average from the time that we start working with our client, and we represent the sellers in the transaction, it takes about 4 months on average to vet out the candidates, to negotiate the deal, start to get the financing lined up, get the formal agreements completed, and so forth. And so that portion where we're selecting the best candidate, we're getting the best deal, and then getting prepared for the transition is approximately 4 months. And then the transition of clients itself, on average, is a 6-month period. And unless you have quite a large practice, with 1,000 clients or something like that, most of the time you can have a very good transition in a 6-month period with very low, if any, client attrition. And we help, in our process, we also help plan the transition, the communication to the clients, so on and so forth. Let me add a little bit to our evaluation process that Tony mentioned. We've put a lot of time into making the data collection portion of it as easy as possible for the advisor, because again, it's one of those things that we recognize with our competition. It's quite a lengthy and difficult process because you're going to search for all the data and put it into a questionnaire, whereas what we've tried to do, especially with our partner firms, is identify specific reports where we can collect the data from and you don't have to. And so the example that he gave, like an Ameriprise advisor, we get people that can turn around that really brief questionnaire and the reports in literally a matter of minutes. So we've really put a lot of thought and focus on not taking a lot of your time. Did we hear someone else going to ask a question?
Okay, last call. If you have a question, unmute your phone by dialing *6, or you can type it into the chat button at the top.
Will we be
Going
receiving
once?
this deck? Can you hear me?
Yeah, I'd say, will you be receiving this deck?
Yeah, the deck.
No. No, this deck is not being distributed, but there is a replay of this presentation on our website. actually not on our website, on our YouTube channel. And following today's session, you'll be getting a follow-up email, and on it we'll have a link to complete a short survey, which should take less than 60 seconds. And you can also put in your contact information so that we can contact you. And then I can include a link to the replay information as well.
Okay, thank you.
Mm-hmm. Any other questions? All right, well, again, you can go directly to our website and place an order, which gets the process started. If you have any questions, you can feel free to contact us. And I would ask that you take a couple minutes to fill out the survey once you get the email from us. Thanks, and have a great day.